When investors hear the phrase alternative investments, the imagination often runs ahead of understanding. Some picture secret assets, reserved for institutions and the ultra-wealthy. Others assume alternatives are simply riskier bets, dressed up to look sophisticated. Both views miss the real point. Alternative investments exist not to impress, but to solve a problem that traditional portfolios inevitably face: over-time concentration in the same economic forces. Stocks and bonds, despite their differences, are still deeply tied to interest rates, growth expectations, and financial cycles. Alternatives attempt to introduce sources of return and risk that behave differently, especially when the familiar engines of markets begin to sputter. At a basic level, alternative investments include assets outside publicly traded stocks and bonds. Real estate, private equity, private credit infrastructure commodities, hedge fund strategies, and even collectibles fall under this umbrella. What unites them is not a single risk profile, but a shared characteristic: they are less liquid, less transparent, and less standardized than public markets. This lack of simplicity is precisely why they can add value, but it is also why they demand more discipline and understanding from the investor. The role of alternatives is often misunderstood as return enhancement alone. In reality, their more important function is diversification of behavior. Public markets react instantly to news sentiment and macro signals. Alternative assets tend to move more slowly, driven by cash flows, contracts, appraisals, or long-term projects. This can reduce volatility on paper, and more importantly, reduce the psychological pressure that leads investors to make poor decisions at the worst possible times. When a portfolio includes assets that do not scream at you every day through a price quote, patience becomes easier to maintain. Real estate is often the first alternative investors encounter because it feels tangible. Buildings produce rent, land exists regardless of market sentiment, and leverage can amplify returns. But real estate is not a single asset, it is a spectrum. Residential, commercial, industrial, and specialized properties each respond to different economic forces. Location, financing structure, and management matter far more than broad market direction. Real estate can provide income and inflation protection, but it can also trap capital for long periods and magnify mistakes when leverage is used carelessly. Private equity and private credit move even further away from public market rhythms. These investments rely on long holding periods, operational improvement, and contractual cash flows, rather than daily price discovery. The returns can be attractive, but they come with real costs: illiquidity, complexity, and dependence on manager skill. Unlike public markets where average returns are accessible through low-cost vehicles, private markets are far more uneven. A small number of managers generate the majority of gains, while mediocre ones quietly consume time and capital. Alternatives reward selectivity, not participation. Commodities and real assets introduce another dimension. They often behave differently during inflationary periods, supply shocks, or geopolitical stress. Energy, metals, and agricultural products are driven by physical constraints rather than earnings growth. This makes them useful hedges in certain environments, but unreliable long-term compounders on their own. Timing and sizing matter greatly. Used thoughtfully, they can stabilize a portfolio. Used emotionally, they become vehicles for speculation disguised as protection. One of the most dangerous misconceptions about alternative investments is the belief that complexity equals sophistication. Complexity only adds value when it addresses a specific portfolio weakness. Adding alternatives without understanding their role leads to overlap, hidden leverage, and false diversification. Many portfolios labeled diversified are in reality exposed to the same underlying risks through different wrappers. True diversification is about behavior under stress, not the number of asset names listed on a statement. Another critical factor is liquidity. Alternatives often lock up capital for years. This illiquidity can be a feature-forcing discipline and reducing impulsive selling, but it can also become a liability when cash is needed unexpectedly or when opportunities arise elsewhere. Investors must be honest about their time horizon and cash flow needs before allocating to assets they cannot exit easily. Illiquidity is only rewarded when it is willingly and intelligently accepted. Alternative investments also demand humility. Returns are harder to measure. Benchmarks are less clear, and narratives are seductive. Without rigorous due diligence, investors risk confusing stories with substance. The absence of daily pricing does not eliminate risk. It merely delays its visibility. Losses in alternatives often reveal themselves slowly after decisions are difficult to reverse. This is why alternatives should never be approached as an escape from market discipline, but as an extension of it. At their best, alternative investments expand the toolkit of a thoughtful investor. They offer exposure to different economic drivers, smoother return paths, and opportunities unavailable in public markets. At their worst, they introduce opacity, complacency, and irreversible mistakes. The difference lies not in the asset class itself, but in clarity of purpose. Alternatives must answer a specific question: what problem in the portfolio are they meant to solve, and at what cost? As portfolios grow and financial lives become more complex, the temptation to move beyond stocks and bonds naturally increases. The challenge is not access, but judgment. Understanding when alternative investments genuinely improve resilience and when they simply add complication requires a clear framework for role risk, liquidity, and expectation. And that is where the conversation must go next. Because without that framework, alternatives stop being tools and start becoming distractions that feel sophisticated while quietly undermining long-term outcomes, which brings us directly to the next part, where we need to examine when alternative investments truly strengthen a portfolio and when they simply add complexity without compensation, because this distinction defines whether moving beyond stocks and bonds is an act of wisdom or an expensive detour. Alternatives add real value when they introduce return drivers that are genuinely different from public markets, and when those drivers are aligned with the investor's time horizon, liquidity needs, and temperament. Long-term infrastructure projects with contracted cash flows, well-underwritten private credit, with clear covenants, or real estate backed by durable demand, can provide stability and income that behaves differently from equities during stress. In these cases, alternatives are not chasing higher returns. They are reducing the likelihood of being forced into bad decisions at the wrong time. Alternatives begin to undermine outcomes when they are used to mask discomfort with normal market volatility. Illiquidity can feel like stability because prices do not move every day, but the risk still exists, waiting quietly. Investors who allocate to private assets without understanding leverage fee structures or exit conditions often discover problems only after flexibility is gone. High fees combined with mediocre performance can erode returns for years before the damage becomes obvious. Complexity, when not paired with insight, compounds disappointment rather than wealth. Manager selection is decisive in alternative investing. In public markets, average exposure can be sufficient. In private markets, average often means failure. The dispersion of returns is wide, and access to top-tier managers is limited. Due diligence is not optional, it is the entire game. Understanding incentives, track records across cycles, and how managers behave when conditions turn against them matters more than glossy presentations or impressive narratives. Alternatives reward skepticism far more than optimism. Sizing also matters. Alternatives work best as complements, not replacements. Overallocating to illiquid assets can create fragility, especially when life events or market dislocations demand flexibility. A resilient portfolio maintains the ability to rebalance, seize opportunities, and meet obligations without selling under pressure. Alternatives should reduce stress, not introduce new forms of it. Their role is to support the core, not dominate it. Perhaps the most overlooked benefit of alternatives is behavioral. When chosen well, they can anchor a portfolio providing cash flow and stability that allow equity positions to be held through turbulence. But this benefit disappears if the investor does not trust or understand the investment. Confidence built on ignorance is fragile. True comfort comes from clarity, knowing why an asset is owned, how it is expected to perform, and under what conditions it might fail. The central lesson is not that every investor needs alternatives, but that every alternative must justify its place. Stocks and bonds remain powerful, transparent, and efficient tools. Moving beyond them should be a response to a specific need, not a desire to feel sophisticated. Alternatives are not a shortcut to superior returns. They are a test of discipline, patience, and humility. In the long run, portfolios succeed, not because they contain exotic assets, but because they are coherent. Each component has a role, a risk, and a reason for being there. When alternative investments are integrated with that level of intention, they can enhance resilience and improve long-term outcomes. When they are added casually, they often become silent sources of underperformance that are discovered only in hindsight. If this discussion helped clarify whether alternative investments belong in your thinking, consider subscribing to stay with these deeper, long-form conversations about building durable portfolios rather than chasing trends, and leave a comment sharing what alternatives you have considered or avoided, because the most valuable insights often emerge when experience meets reflection.